I'm going to spend the next couple slides on basically a flow chart, how I work with myself and how I've been structured. And I've set myself up in a corporation over 20 years ago. Personally, I haven't gotten a commission check for over 20 years. My corporation gets a commission check. So I'm going to basically give you a structure, how to not only build a business, but also build your financial future. We talked about it last week. You don't get rich by selling real estate. You get rich by owning real estate. You need to be your best client. But at the same point, I know a lot of people are saying, well, geez, where do I get the money for that? Well, if you follow the Blueprint to Success principles, you're going to make more money. But instead of spending more, you want to spend less so you can invest the difference. So let's start. Number one is income. So this is a total GCI that you have coming in, and then obviously your company takes their share, and then this is the income. So what happens is every commission check that I get goes to my corporation. Now what my corporation does with that commission check is it does one of two things. First off, you need to pay yourself first. You've kind of heard that. You need to pay yourself first. That's what this means. I know what my personal expenses are, so I make sure I pay myself enough money to make sure that it covers my personal expenses. Not a lot more money than that, but it will just cover my lifestyle. And maybe, a little bit extra some months, obviously. We'll talk about what happens with bonuses when you make more, but you want to be conservative at this mode right here. And the good part is taxes are taken out. So at the end of the year, before I was a corporation, I'd get a tax bill sometimes of $50,000 and I couldn't pay it. But now, at the end of the year, I don't owe any taxes because my taxes are taken out of every paycheck that I get. So first off, what does a corporation do? Well, the corporation basically will put money in reserves. First thing they'll do is they'll pay any business expenses. And that's the greatest part about having a corporation. Phone, car, and I'm not going to tell you what you can write off, what you can't write off. It all just depends how you use it. But for the most part, almost your entire life has something to do if you're a full-time real estate professional. And if you're a full-time real estate professional, then almost all of your expenses are coming through, or at least a percentage of them, your business is paying. Out of those, one of the things you want to make sure you invest in is education. And why do I put education there? Because obviously you have a lot of expenses. Because to me, education is like investing in yourself. Just like on the personal side, we're going to talk about investing in real estate. Education is so important. And that's why I honor you guys for being here today with me every single week, because you guys understand you have to invest in your education. But then over here, so whatever's left over after the expenses, you put in the reserves. Hey, reserves are so important during the slow time. You've heard my story. Early in my career, I had to sell my car to put food on the table for my family. So you want to pay your expenses, and anything over here, you want to get reserves. Out of those reserves, you pay down any debt. You should go out and try to get a line of credit once you set up a business. And whatever corporation, whether C Corp or S Corp, this is where you need professional help, that they understand what your goals are and what you're trying to accomplish. But out of those reserves, you should have a line of credit. I always have a line of credit for my business. And you know what? Sometimes I still pay myself first. I always pay myself, so I pay all my personal bills. But maybe I don't have enough to pay those business expenses. So I'm able to basically put money into my corporation for my line of credit. Or if I built up reserves, I'm able to put it here. But sometimes, like I said, I don't have the reserves. I have to take for a line of credit. And at that point, when I do have reserves, like let's say the next month, then I'll pay down any debt. So what happens to the money when I get it personally? Okay, now I get a paycheck. 70%, this is what I try to live off. 70% is what my actual expenses are. And that's how I try to set it up. I try to set it up where if my expenses are $7,000 a month, I want this to be $10,000 a month, my paycheck, let's say. And then I always put money in reserves, because then otherwise you're always kind of up and down and up and down, as far as, hey, I need a check. You don't get a check. You try to be consistent with your checks. You don't sit there and say, oh, I need more money, so I'm going to take a bigger check. No, take a little bit extra so you can put 10% in reserves. Then you want to put a 10% in your investment fund. Now, I like real estate, but it doesn't have to be real estate. It can be stock market or whatever. But I will tell you, real estate is one of the safest investments. And because we're full-time real estate professionals, we get tax breaks from owning real estate that other people don't get. I'm not going to dive into it. That's for your CPA, because everyone's situation is different. And then I do feel that 10% should go to charity. That's what I do. We have a lot of things. If you look on our website, not only from a corporation, but personally, we support a lot of charities. I'm a big believer in that, as you put out, you'll get back. And so anyway, that's the way personally it goes through. So now what happens next? So remember, we were putting money in reserves. Well, the one thing with most corporations, now S corporations have a flow through where the money flows through, but a C corp, which is where I'm at, it can only have a certain amount of money at the end of the year, because you get into double taxation. So if I leave money into my C corp and I don't take it at the end of the year as a bonus, then what will happen is at some point in 6 months, if I need it, I take it. My corporation paid tax on it, and then I have to pay tax. That's when you hear a double taxation. So at the end of the year, whatever extra that I've put into reserves that I need to take out as a bonus. So I have an end of a year bonus. This is really where the fun begins. Because even though you might be able to pay yourself $15,000 a year, a month, $15,000 a month, but you only pay yourself 10 because your expenses are 7, you live within your means. So now at the end of the year, that extra $5,000 times 12 is $60,000. Now all of a sudden you pay yourself a bonus of $60,000. Now my payroll company in that bonus takes the taxes out. So I still don't owe any taxes, because if I get that $60,000, who knows, maybe $20,000 will be paid out in taxes, or $15,000, probably more like it. Just depends on where you fall. Now remember, you're already building up a personal reserve. You're already building up an investment fund. You're already basically given the charity at the end of the year. So what do you basically do with that end of year bonus? Well, your expenses are already paid, so you don't have to pay that. So 40% is paying down investments. You have a house. Let's say you've purchased a home. Roll that extra money, 40% of that, $40,000, $45,000 that is out of the bonus, pay down. Because what you want to do is, it's called investment pyramiding, where if you have 3 rentals and you have loans on all of them, you pay down the one, and then all the money you were put into that one, you basically now put it on the second one, and it pays that one down twice as quick. Now, as soon as you pay that house off, then you put in all that money. You don't spend it. You put all that money towards the third house. You're paying off that third house in a third of the amount of time that you did the first house. So you want to take 40%, pay down investments, pay down your real estate investments. Then you want to take another 40% and put it in an investment fund, because this is where you basically, this is where remember we put 10% from your income before out of that $10,000 monthly. You took 70% for expenses, 10% for charity, and you also take 10%, put 10% for reserves, and you put it in an investment fund. Well, you add this 40% of whatever your bonus is into that investment fund. So it builds up. So now you can go out and buy a piece of real estate, because you want to make sure when you purchase a piece of real estate, try to do it with enough money. And this is the whole idea of paying it down. You want a positive cash flow on that house, because where we get killed is when the market, if you own real estate, which you should, and the market slows down, you don't have as much money coming in, and now your home might not rent as quickly, that market goes down. I always tell people that are investing in real estate, you can't lose in real estate. The only time you can lose in real estate if you sell during a down market. But if you have a positive cash flow, you just don't sell during the bad market. What people did during the 2007, 8, 6, 5, they literally took a house that they almost had paid off and took money out of it and bought 5 more houses. So now they literally had 6 homes and none of them were a positive cash flow. So when the market went down, they were upside down and they ended up losing everything. So again, I do lean a little bit more on the conservative side. I would rather have a home paid off than 2 homes that only had 50% equity. That's just me, but again, 50% equity is fine because 50% equity means you probably have a positive cash flow too, but that's kind of what you're going for. Still out of the bonus because it's money to you. I still have 10% to charity. And here I have 10% for you and the family. Remember, you're making enough money from your monthly check to pay all your expenses and everything like that. This is the fun. This is the fun part of it. If you ever seen the 3-bucket approach, so basically you have 1 bucket here, 1 bucket here, and then 1 bucket here. What I did early in my career, and a lot of people do, this is basically your bills. This is your college education. This is your life insurance funds. Those are the things that are most important, your investment. And so what happens is when that bucket is full, when you've got everything paid, now the extra money tips down to this one. What this bucket is, that's your real estate investments. Those are your stock investments. Now, once you've got the essentials taken care of, only when that bucket is full, you basically then tip down to this bucket and do investments. Now, once you've got a good base for investments, this is where it tips down to this bucket. You know what? Those are the cars, the vacation house, the fun things in life. Too many times we take our income and we go straight down in here. Understand, you got to fill the first bucket, it tips over to the second bucket, and then it tips over to the third bucket. That's what this is. This is kind of the third bucket, the special vacations, the extra car, maybe the vacation home. My wife and myself have owned vacation homes, and in one, we rented it out for 2 years, and before we even started using it. The other one we rented out for 6 years before we started using it because we were getting $50,000 a year rent because it was in a nice neighborhood in a nice area. So we were getting $50,000 a month rent. You know what? It was up in Tahoe. I couldn't justify for going up a couple weekends of the year to give up that $50,000. So when we went up to Tahoe, we rented, a condo for $1,000. It was a lot cheaper. We might have spent $5,000, $6,000, $7,000, $8,000, $9,000, $10,000 during the year, but we had $50,000 coming in. Well, after 6 years of doing that, you get to a point because you will never ever be able to justify having a second home and not renting it out. Financially, you'll never be able to justify it. You just get to sometimes in a point in life when you've filled up this bucket, where you get to a point saying, okay, you know what, I'm not going to rent that investment home, that vacation home out anymore. It's just going to be ours. But you've earned it by going through the 3 buckets. So hopefully that makes sense to you. You take out the bonus, you still put your charity. But again, by the time, remember, this bonus is after you've paid all your expenses, you've put in your reserves, you've put in your investment account. So it's okay to start dipping into this bucket now because you've already got these. So hopefully that makes sense to you guys.